You didn't forget to pay a bill. You didn't max out your card. You didn't suddenly become bad with money. And yet, your credit score dropped. Not by 1 or 2 points. Enough to notice. Enough to make you pause and think, wait, what? That moment matters more than people admit, because a credit score drop doesn't just feel confusing, it feels personal, like you broke a rule no one explained. But here's the uncomfortable truth most finance advice skips. Your credit score isn't judging you, it's reacting to you. And sometimes it reacts badly, even when you do nothing wrong. Let's talk about why this keeps happening and how to reverse it faster than most people think. Right now, credit scores carry more weight than ever. Interest rates are high. Lenders are nervous. Approval standards are tighter. A small drop today doesn't just hurt your ego, it changes your cost of borrowing, sometimes by thousands of dollars. So when a score falls without warning, it feels unfair. That's because we're taught the wrong mental model. We're told credit scores are about responsibility, pay on time, be disciplined, you'll be rewarded. But the system doesn't work like that. A credit score is not a report card, it's a risk snapshot. It doesn't ask, is this person good with money? It asks, does this profile look more or less risky than last month? That's a very different question. Every month, lenders send a snapshot of your accounts to credit bureaus. Not your full history, not your intentions, just a frozen moment. Your balance, your limits, your open accounts, your closed ones. If that snapshot looks even slightly more stressful than before, the score reacts immediately. No context, no explanation, just movement. The most common reason scores drop is also the most misunderstood: credit utilization. This is how much of your available credit you're using when the statement closes, not how much you plan to pay later. Here's how this quietly hurts people. You have a card with a $10,000 limit. You usually keep the balance low, maybe $800. That looks calm, predictable. Then one month, life happens. Travel, repairs, a larger purchase. Your balance hits $3,200. You plan to pay it off soon, so you don't worry. But the statement closes right there. Now the system sees you using 32% of your limit instead of 8%. To you, nothing changed. To the algorithm, risk just increased. And utilization is powerful. It can move a credit score 20, 30, even 50 points, faster than almost anything else. Here's the irony. People who actively use credit often see more score swings than people who barely touch it, because activity creates data, and data creates volatility. Next comes a drop that feels almost insulting. You pay off a loan, car loan, personal loan, something responsible, and your score goes down. How does that make sense? Because your credit mix changed. The system likes seeing different types of debt handled over time. When a loan disappears, your profile becomes simpler. Simpler sounds good to humans, but to a scoring model, it means less evidence. Less evidence equals uncertainty. Uncertainty equals risk, not punishment, just probability. Then there's account age, another quiet trigger. When you close an old credit card you don't need, you're not just closing a card, you're shortening your average credit history. Imagine two people. One has accounts averaging 10 years old, the other averages 3. Same behavior, different stability. The system prefers time, not because time means virtue, but because time means predictability, and predictability is what lenders pay for. Now let's talk about something subtle but damaging: hard inquiries. Every credit application sends a signal. One inquiry is normal. Several close together tell a story: urgency, pressure, uncertainty. Even if you were shopping responsibly, the algorithm doesn't know that. It only counts frequency. Intent doesn't matter. Patterns do. Here's the key realization most people miss. Credit scores are extremely short-term sensitive. They are not measuring who you are financially. They're measuring who you look like this month. That's why drops feel sudden and why fixes can happen faster than expected. So how do you fix a score drop quickly? First, control the snapshot. If utilization caused the drop, timing matters more than payment size. Pay balances down before the statement closes, not just before the due date. This changes what gets reported. Many people see rebounds within 1 or 2 billing cycles just from this adjustment. Second, don't rush to close accounts. Unused credit isn't wasted space, it's structural support. Old accounts stabilize your profile. They absorb shocks. Third, don't panic apply for new credit to balance things out. That almost always makes it worse. Credit scores improved through calm, not activity. Fourth, check for errors. Late payments reported incorrectly, balances duplicated, old accounts marked open. It doesn't happen constantly, but when it does, it matters. And finally, time, but not forever. Utilization drops can reverse quickly. Inquiry effects fade. Even negative marks lose influence if they don't repeat. The system remembers patterns, not isolated moments. Now zoom out. Here's the uncomfortable big picture. Credit scoring systems were never designed to help you feel secure. They were designed to help lenders manage uncertainty. Your goal is stability. Their goal is prediction. Sometimes those align, sometimes they don't. A score drop doesn't mean you failed. It means the model saw something different than last month. The real mistake isn't the drop. It's misunderstanding why it happened and reacting emotionally instead of strategically. So next time your credit score falls and nothing obvious seems wrong, don't ask, "What did I mess up?" Ask a better question. What did the snapshot show that I didn't notice? Because once you understand that, the system stops feeling random and you stop feeling powerless. The credit score isn't watching your life, it's watching a moment. And moments, unlike myths, can be managed.